Hi there, everyone, and welcome into this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so our market actually managed to take a bit of a fall today, but not really all that far, especially compared to where the S&P 500 closed last night, about 1.8% down. So our market once again is being extremely resilient. We actually traded up close to being in the green for quite a big part of today, but then failed back down after the RBA announced another quarter of a rate hike at 2:30. But it really didn't harm markets all that much. You can see here it was only a very slight fall. And the overall uptrend that we're on in the short term here is definitely still intact. We are finding ourselves inside a ascending triangle now, with it pulling back ever so slowly towards the longer term uptrend line. We'll wait and see which way it breaks. If it breaks lower, then could see a pullback all the way to 7,000 on the cards. Otherwise, if it breaks through this little counter trend line here, well, sky's the limit, right? So, 76 all-time highs. Double bottom is actually telling us that 76 is on the table. That inverse head and shoulders through here is also saying 76 is on the table. So I wouldn't. I still feel it's doubtful in the short term, but it's definitely on the table technically. So we can't ignore that. So let's get across the S&P 500. Okay, it's a little bit different over there, right? What we're seeing on the chart because the downtrend is definitely still in play. We came and tested that. Well, they came and tested that downtrend a couple of sessions ago. Have failed now. Come back below the 200-day average. And you can see every time we've tested the 200-day average in this downtrend, a significant pullback has followed. Now, not saying that that's going to be the case straight away. This time, the moods in the market definitely has changed a little bit, although the risks haven't. And I'll talk to that a little bit more in a moment. But same deal here, inside of a pennant pattern, looking for a breakout. If to the upside, 43 is probably the ultimate optimum target, really coming into Christmas. A break to the downside, well, we could float ourselves back down near 38 or 37 quite easily as well. So either or is on the table, and this is the thing of trading inside a triangle pattern like this. That as you edge closer, you're waiting for the breakout to try and determine what the next move is. So that's where we're at, really, technically, guys. Okay, downtrend, is it going to stay in play or is it going to break? For the US, that's the $1 million question. You do have the start of a double bottom here. You've also got the inverse head and shoulders. There's quite a few reversal patterns kind of playing out here for the moment, but none of that really makes, I don't really look at a lot of that until it breaks through that downtrend properly. Okay, and that's what we're looking for. So as I mentioned before, the RBA lifted rates by another 0.25% today to 3.1%, lagging way behind what the US is expected to be next week. So, RBA is definitely going at a much slower pace than many other central banks or Western central banks around the world. They did note that they are likely to continue to lift rates, and they're not on a set course, which is basically what they've been saying for a little while now. Not on a set course, and it will be dictated by how inflation goes, the economy, jobs, and the rest of it. So, look, I think it's pretty tame, really, compared to what we're seeing offshore, and that's one of the other reasons why our market's outperforming a little bit here as well. We've got strong exports here in this country, which is really going to help our market, being a very much a value-based market, to outperform in a higher interest rate environment. Whereas a heavily growth-based market like the US will likely underperform for a period of time until rates start coming back down again. Okay, so look, RBA has lifted rates, but it's really not a big deal if you compare it to what's happening overseas. The other thing to consider is, lifting rates is a massive lag effect. They did talk about that in the announcement today. It is a lag effect when it comes to interest rates, especially that a lot of people fixed rates when they were low either over the last few years. Okay, and a lot of those fixed rate loans come out up to maturity next year. So a lot of people are going to feel the pinch next year. That's where you might see the economy slow a bit further. So it's going to be an interesting one for 2023, both here and overseas. The other thing they noted in the announcement today is that the global growth is slowing and forecasted to slow significantly next year as well. Now that's obviously going to help bring inflation down, but also can have other risks and damages to the economy. So just yeah, next year's going to be an interesting one. That's all I'm going to say there for the moment. Now, the next big bit of news, really, that can rock markets a lot, will be the CPA and the CPI and the Fed next week, right? Back to back, right? So you'll have the CPI on Wednesday, the Fed Thursday morning. So yeah, it's going to be an interesting midweek next week to see what happens there. Now, the Fed is expected to lift by 0.5% at this stage. Now, if that CPI reading comes in high, there's a half a chance they'll go 75 points. That will knock the market down a lot if that plays out. I doubt it will. The likelihood of the CPI being high is low, considering some of the other data we've seen around this recently. So, um, I dare say at this stage the CPI will come in similar to last time, maybe a little bit lower, touch lower, it's tiny little bit lower, and then you'll see the Fed just lift rates by 0.5% as expected. Say similar things that they've been saying, that they're aiming for a soft landing. Will they get that or not? Time will tell. And then that they'll continue to lift rates until inflation clearly starts coming down. All right, so this market's going to move around over the next sort of 6 months or so based on the view of a hard or soft landing, right? It's pretty certain, and I think the market's priced in the fact that there's going to be a recession, right? The Fed has been loud and clear all the year this year that they're trying to cause a recession to bring inflation down, but they're trying to do it in a way where they'll go for a soft landing. And we saw the announcement from Jerome Powell last week. Okay, he really talked about the scenario of what a soft landing would look like, with reasonably good job numbers and good unemployment rate and this and that and the other. The market lapped that up, right? Big move up off the back of that announcement. What a lot of people are missing though is that's a scenario. He's not saying that he thinks there's going to be a soft landing. He's saying the soft landing scenario is this. But there's still risks of a hard landing and still massive risks of that happening next year. And I think the market will wake up to that again and we'll see a lot of volatility. So look, for me, my prediction is at some point we're going to probably head back down towards that 37 or 36 level on the S&P 500. Can't tell you the timing. Okay, I really can't. It's going to come down to data on when that timing comes through. The likelihood for me at this stage, and this is without seeing the CPI data next week, is we'll probably pull back a little bit into that announcement, and then if the CPI and the Fed comes through as expected, we'll have a little bit of a Christmas rally. Nothing too massive because we've rallied too hard already, but I think we'll see a little kick up into Christmas sideways, and then things will get rocky again, sort of towards the end of mid-Jan, when we start coming into earnings, start getting close to the next Fed announcement, start seeing the next CPI reading, all that sort of information that gets people nervous again. So, taking that out, the next big thing obviously is China looking to relax their COVID zero policy. We've seen mixed reactions to the market. A big thing is obviously metals, mining, iron ore have flown on the back of this. And that's really helped our market hold strong as well. So, if the rhetoric continues that China is going to continue to relax their COVID zero policy, our market could hold up quite strong for a little while here, right? We tend to do something in between China and the US, right? We don't just follow the US 100%. If China's strong and the US is weak, we'll kind of sometimes go sideways. Our material stocks tend to follow what's happening in China a bit more than what's happening in the US, where other pockets of our market will react to the US very, very closely. So just keep that in mind, right? So we're always keeping one eye on China and what's happening over there, and demand for iron ore is so critically important for our market. Iron ore's had this huge rally over the last 6-7 weeks, and that's why BHP, Rio, Fortescue, iron ore type miners have rallied so much. So yeah, keep an eye on this space, guys, because as we know, the mood towards these things can flip pretty quickly. Okay, and what's interesting is that OPEC is still cutting production, which means they're kind of thinking that there's still recessions on the table here, right? And that there's going to be weakness in the economy next year. So yeah, look, interesting times, guys. As I said, I think the big thing is, will the US go for a soft or hard landing next year? Signs of a hard landing, the market's going to pull back. Signs of a soft landing, the market's going to kick up a bit. How long will the Fed have to lift rate, or how high will the Fed have to lift rates to, and for how long? Okay, it's not necessarily for how high, also for how long. Ideally, we'll want to see it snap up to 5% and then start falling by middle of next year. If inflation doesn't fall, well, guess what? They might have to hold rates higher for a longer period of time and do much more damage to the economy. And these are all the unknowns faced to us next year. And, the thing is with markets, they can price in good news, bad news, but it's very hard to price in this uncertainty. Okay. So let's just see whether the uncertainty kicks back in and we see big pullbacks or not, see if the volatility returns, or whether we're just going to be in this sort of sideways whippy market for a period of time. I'm not sure at this stage. I think we've got the next big piece of that puzzle next week when we see the CPI reading. All right, well, I'm going to leave you there. Thanks for listening in. Take care and bye for now.